There was a version of me who used to nod along whenever someone brought up terms like compound interest, or credit score, or diversification, like I actually knew what they meant. I didn't. And here's the wild part. Most people don't either, and they've been quietly faking it for years, exactly the way I did. Something like 6 out of every 10 adults can correctly answer 3 basic money questions on a standard test. That's not a math problem. Nobody actually teaches this. The whole system just kind of assumes you'll figure it out on your own, and most people never do. Stick around, because by the end of this, you're going to understand more about money than most adults you know, and none of it is complicated once someone actually walks you through it. Let's start with the one that sounds the scariest and is actually the simplest: compound interest. Picture this. You lend a friend $100, and he agrees to pay you back 5% extra each year he holds on to it. Year 1, he owes you 105. Fine, easy math. But if he never pays you back and that 5% keeps applying every single year, year 2 isn't 110. It's 110 and change, because now you're earning 5% on the 105, not just the original 100. That tiny extra bit is the whole secret. It looks like nothing for the first few years. Then somewhere around year 15 or 20, the line on the graph stops looking like a slope and starts looking like a cliff. Now stretch that same idea across a real number. Someone who puts $200 a month into an account earning 7%, starting at 25, ends up with something close to $525,000 by 65. Someone who starts the exact same habit at 35 instead ends up closer to 245,000. Same monthly amount, same return, and 1 decade of delay cut the outcome by more than half. That's compounding. It's not a strategy. It's math quietly working in your favor or against you, depending on which side of it you're standing on and how early you let it start. And that leads straight into the concept people fear the most: credit score. Here's what it actually is, stripped of all the mystery. It's a number, usually somewhere between 300 and 850, that tries to answer one question for a lender. If I hand this person money, how likely are they to pay it back on time? That's it. That's the whole thing. It's built from a few ingredients. Do you pay your bills on time? That's the biggest one. How much of your available credit are you actually using? Ideally, under 30%. How long have your accounts existed? Older is better. And how many new accounts have you opened recently? Too many at once looks risky. Picture 2 people applying for the same car loan. One has a score around 780, the other around 620. Same car, same price, same dealership. The first person might get an interest rate near 5%. The second could get offered something closer to 14% on the exact same loan, which on a $25,000 car adds up to thousands of dollars in extra interest over the life of the loan, purely because of that number. None of this is secret information designed to trip you up. It's closer to a trust score built from your own habits. And the wild part is, once you understand the 4 ingredients, you can start moving the number almost immediately just by paying on time and not maxing out a card. Most people never check theirs until they need it for something big: a mortgage, a car, a new apartment, which is exactly the worst time to discover it needs work. Now let's talk about debt, because debt gets treated like it's always the villain, and that's actually wrong. There, good debt and bad debt, and the difference isn't the size of the number, it's what the money did for you. A loan on a home that grows in value over time, or an education that increases what you can earn, that's debt working for your future. A balance on a card charging 22% interest for a purchase that lost its value the moment you bought it, that's debt working against you, and fast. Picture someone who puts a $2,000 vacation on a card and only pays the minimum. At 22% interest, if they only ever pay the minimum, that trip can end up costing well over $3,500 by the time it's finally paid off, years after the memory has faded. Same trip, nearly double the price, just spread out quietly enough that it never felt like a single painful decision. Here's the simplest test. Ask if this debt is buying you an asset or buying you a feeling. Assets can pay you back over time, feelings can't. Which brings up a related idea most people never got taught either: the difference between an asset and a liability. An asset is something that puts money in your pocket over time: a rental property, an investment account, a business that runs without you standing there every hour. A liability is something that takes money out of your pocket over time, even if it feels like an achievement while you're buying it. A car depreciates the moment you drive it off the lot. A bigger house means a bigger insurance bill, a bigger tax bill, and more to maintain. Two neighbors can drive the exact same looking car into their driveway on the same day, one financed at a low rate as a practical choice, the other stretched to the edge of what they could afford just to keep up appearances. From the outside, they look identical. Underneath, one is building towards something, and the other is quietly bleeding. None of that makes those purchases wrong. It just means they belong in a different mental category than an asset does. And confusing the two is exactly how someone can look successful on paper while quietly building nothing underneath it. Next, the emergency fund. And I promise this one is more interesting than it sounds. Picture two people whose car breaks down on the same day, same repair, same $900 bill. One person opens an account, pays it, moves on with their week. The other puts it on a card at 24% interest because there's nothing else to pull from. And now they're paying that $900 off for the next 8 months with interest stacked on top. Same emergency, completely different outcome. Nothing about the second person was reckless. They just never built the one thing standing between a bad week and a bad year. The emergency fund isn't about being rich. It's about having 3 to 6 months of basic expenses sitting somewhere boring and accessible, not invested, not locked away, just there, waiting for the day the water heater dies or the job disappears without warning. Then there's budgeting, and I know the word alone makes people's eyes glaze over, so let's make it simple. One version that actually works for most people splits your take-home pay 3 ways. Roughly half goes to needs, rent, groceries, utilities, the stuff that keeps the lights on. About 30% goes to wants, the stuff that makes life enjoyable, and the remaining 20% goes towards savings and paying down debt. Say you take home $4,000 a month. That's roughly $2,000 for needs, $1,200 for wants, and $800 that goes straight toward your future before you even feel like you're missing it. That's it. You don't need 40 spreadsheet categories. You need 3 buckets and the discipline to glance at them regularly. Now, diversification, which sounds complicated and is actually just an old idea in a suit. Don't put all your eggs in one basket. If you own one single stock and that company has a terrible year, your entire investment has a terrible year with it. Think of someone who put their savings entirely into one company they loved working for, and then that company had a rough couple of years. Their whole financial future was tied to one boardroom's decisions. If you own a small slice of hundreds of companies at once, through something like a broad index fund, one company having a bad year barely moves the needle because you're not betting on one outcome. You're betting on the overall direction of an entire economy over time, which historically trends upward far more often than it trends down. One more piece before we get to the last one, and it's the piece that quietly costs people the most money simply by being ignored. Where you hold your investments matters almost as much as what you invest in. A retirement account with a tax advantage lets your money grow without the government taking a cut every single year along the way, sometimes not until decades later, sometimes never. A regular taxable account doesn't offer that shelter. Picture two people investing the exact same amount in the exact same fund for 30 years. The one using a tax-advantaged account can end up with tens of thousands of dollars more at the end, not because they picked better investments, but because less of the growth got skimmed off every year by taxes along the way. Same contributions, same fund, same market, and one of them simply chose the right container to hold it in. This is the part most people skip entirely, not because it's complicated, but because nobody ever explained that the account type is a decision too, separate from what you actually buy inside it. Last piece of the foundation, inflation, the quiet one that erodes money sitting still. If prices rise around 3% a year and your savings account pays you nothing close to that, your money is technically growing in the account and shrinking in what it can actually buy at the same time. $10,000 sitting in a drawer today buys noticeably less in real terms 10 years from now, even though the number on the bill never changed at all. That's why cash sitting completely idle for decades is its own kind of risk, even though it feels like the safest option in the room. Here, how all 6 of these actually connect, because they were never separate lessons. Compound interest is the engine. Your credit score determines what that engine costs you to borrow. Good debt uses the engine to build something, while bad debt lets the engine run against you instead. And knowing the difference between an asset and a liability is what tells you which one you're actually looking at. The emergency fund keeps a single bad week from forcing you into bad debt in the first place. The budget decides how much fuel the engine gets every single month. Diversification protects the engine from any one part failing, and choosing the right kind of account decides how much of that growth you actually get to keep. And understanding inflation is what stops you from parking your fuel somewhere it quietly evaporates while you're not looking. None of this requires being good at math. It requires understanding these ideas well enough that you stop nodding along and start actually recognizing them when they show up in your own life, your own statement, your own next decision. Most people never got taught this, not because it's hard, but because nobody ever sat them down and explained it in plain language, the way we just did. The version of me from the start of this video would have needed every single one of these explained slowly, more than once, and that's fine. That's exactly who this was for. You don't need to master all of it today. You just need to recognize it the next time it shows up, in a loan offer, in a statement, in a conversation where everyone else is nodding along too. Now you have been taught. And once you actually understand the 6 ideas underneath the number stops being something that happens to you. The one is you.